you can call your private equity firm whatever you want. You can call it a family office. You can call it a fund. You can you can call it a leverage buyout firm. You can call it a growth capital investor. But some of these terms matter. All right. So initially, what is now considered to be private equity was leveraged buyouts. In other words, buying a company with some portion in equity down and borrowing the rest, trying to add your capital, your strategic guidance, and your operating expertise as the private equity investor to make it a more valuable business. Not always better, but definitely more valuable, and then reselling it, either by making a public company or selling it to a private or public company, or maybe even another fund. Over time, the leverage buyout business, especially after some mega buyouts that didn't go well, needed kind of a makeover, a name change, rebranding, and so private equity became the term. That was pretty accurate, although, quite frankly, you could call private equity just about any place where you put private capital. But that was the rebranding and leverage buyouts. And then all of a sudden, private equity firms started to stratify. There were large buyout firms, there were mid-market buyout firms, there were small buyout firms, usually referring to the size of transaction they engaged in. And then there were majority recap firms that bought all or most of your company, and other firms that injected growth capital, or minority firms, or mezzanine firms, or structured equity firms. Anybody who was investing to take over less than half of the equity of the company. So firms started to stratify that way. Now, lately, because there is a lot of capital sloshing around and these firms are competing to buy your business, a lot of these private equity investors want to come across as if they're not predatory, they're not going to come in and change your legacy, they're not trying to take your company away from you at less than what it's worth, and they want to work with you to build it into a bigger business. And many of them are authentic in saying that. That said, look, they're still private equity firms. They still have a different agenda and are shooting for a slightly different outcome than you are as the founder selling your firm. So the key is, right, if they're founder friendly, that kind of means that they're investing alongside you, that they're not investing in your business on ambiguous terms. They're not giving you earnout targets that are hard to hit. They're not necessarily kind of controlling what you can or can't do with the business. They're investing capital alongside you to help grow the business together in a collaborative way. And that's a rare breed. There aren't that many firms that are quite that way. So what I would say is if you're approached by a founder-friendly private equity firm, ask a few more questions. And maybe the first one is, what does founder-friendly mean? And it should be translatable into the terms and structure they use to buy a part or a majority or all of your business. And if we can help to clarify any of that, whether it's in retaining us to engage in the conversation with them or just giving you the benefit of our experience and opinion, please navigate over to candor-advisors.com and reach out. Thanks. Have a great week.